Hello, I'm Alan Austin from Calibre, and I'm here chatting today to Mark Wooster. Mark's the Chief Investment Officer of Calibre Investment, and he and his team are responsible for managing the investment solutions that your portfolios are invested in. Mark, we keep hearing at the moment about what's going on with central banks, and they're constantly raising interest rates to try and knock back inflation. Where's that going to end? Are we going to end up in some sort of recession? Because we keep hearing about this.
Yeah, well, we may end up in a recession. The central banks are really definitely trying to slow things down because we've been trying to do too much with too little. So what I mean is we're trying to do too much in terms of all of the money that's been flowing from the pandemic relief. The central banks, we basically had an avalanche of free money or very, very low cost money, and that what we saw is massive elevation in terms of property values and share values and so on. But what we've also seen is a lot of activity. Obviously, what started a lot of the inflation problems was with the war, with the pandemic, and then the war in the Ukraine forcing fuel prices up. The pandemic caused supply side or supply chain issues, so that obviously sparked the inflation cycle. But now it's definitely moved from the supply side and goods to services and wages, and so as we've spoken about before, the central banks are really concerned about the wage price cycle, where consumers and employees keep asking for more wage increases, which then feed into prices, which then feeds into more requests for wage increases and so on. So what the central banks are trying to do is really slow all of that down. They're trying to do it without causing too deep a recession, so they're trying to slow things down without harming the economy too much. And we've just seen actually on the Bloomberg, Federal Reserve just raised rates by 0.25%, where in the past they've been raising the 0.5% and so on.
So that means that inflation looks like it's coming under control in the US.
Yeah.
What's actually going on here? And if inflation's still stubborn here, and the Reserve Bank of New Zealand has to push interest rates up even further, doesn't that mean that we might be looking at what's called a hard landing? And we've been getting investors asking us questions about what does that actually mean? What's a hard landing? What's a soft landing?
Yeah.
Can the RBNZ actually get this under control without doing too much damage?
Yeah, and so the higher the level of inflation and the bigger the problem, the more likelihood that the central bank or the Reserve Bank is going to have to hurt the economy more to get it under control. And we've had pretty high numbers. I mean, we've got 7.2% inflation, and so that's pretty high. But the problem is we've actually had higher numbers in terms of groceries and especially fruit and vegetables. I think the number for fruit and vegetables over last year has been in the 20s. And we're all growing webbed feet at the moment with all this rain in the North Island. Well, that's not helping, obviously, fruit and vegetables either.
So might that just be a seasonal effect, that once we start getting decent weather again, some of those measures that feed into the CPI will actually start to drop back? Yeah,
and that's what the Reserve Bank does. So they remove factors like that from their thinking in terms of, so they're not going to force interest rates up and hurt the economy simply because we've had a bit of a spike in fruit and vegetables. So they will take that into account. They take that into account when there's been a spike in energy prices and so on. So a hard landing, we have had a lot of clients asking what's a hard landing and what's a soft landing and what do they look like. And a hard landing is a bit like what we had in the early 90s, where we had 12% unemployment, business failures, terrible property market. People withdrew from the property market if they had to sell. We saw some houses passing in for 50% of normal valuations and so on. So that's a hard landing. That's what everybody wants to avoid because it causes disruptions, not just in the economy, but it's a major disruption to people's lives.
And New Zealanders, with their penchant for investing in property, are particularly exposed here, aren't they, with one of the highest levels of personal debt around in the OECD. And so if the housing market does actually start to go backwards even faster than it is now, could that cause some real issues?
Yeah. I think the big issue is, can people service this debt, and what's that going to do to the economy? Because we're seeing a lot of items in the news and so on around what it means for just an average household. These lift in interest rates. A lot of people have mortgages that start with a 2 or a 3. They're moving on to mortgages that now start with a 6 or even a 7. That's a major impact on household income and their ability to service it. So when you're talking about that, so what that comes down to then is essentially, can people service that debt, and can they keep their jobs to service that debt? So if things get too bad, that's where the problems start, and because it's not just a matter of the ability to service the debt out of your income. If you lose your job, then obviously that has you're in big trouble in terms of.
And that's, I suspect, starting to happen now anyway, because people are already starting to have to pay increased mortgage rates. So that means less disposable income, less discretionary spending,
Yep.
which in theory should mean that inflation starts to come down.
Yeah, and that will happen. Yeah.
So what does a soft landing look like then, as opposed to a hard landing?
Well, a soft landing, it has some of the same effects, only a lot less. So you won't see the wholesale business failures. You'll see unemployment tick up a bit. And you'll see things slow down, and then you'll see the inflation pressures come off enough that the Reserve Bank doesn't have to keep ramping up interest rates, and they may even be able to drop them back a bit, and that will ease the pressure on households and so on. So that's clearly a much more desirable outcome, and that's what the Reserve Bank is trying to do. But what we've got to remember is that inflation's a big problem, and the Reserve Bank has a pretty blunt instrument, and it's not an exact science. So we've stated in the past that from these levels of inflation, no central bank has been able to manage inflation down without a hard landing. With unemployment where it is, and household savings from the pandemic and so on, and the general strength in the economy, we've got as good a chance as of any of getting this level of inflation down with a soft landing.
So if we do have a recession, and it sounds as if there's a reasonable chance of that happening of some degree, how long do you think that might last?
That's a really good question. My crystal ball's at the cleanest today. So that's the thing that is a little it's serious. It's a serious issue, but it's a little amusing to watch, because people are always trying to forecast, and they build in all sorts of expectations about, by the end of the year we'll be doing this or so on. But the problem you've got is the world's a very complex place, and so but they are talking about that we are going to see quite a few mortgages roll on to new rates this year, and so they are talking about things starting to slow from mid 2023 through to the end of the year. So at that point, once the Reserve Bank starts to see signs that that it is having an impact, then they will at least moderate their rate rises, if not maybe think about a drop in rates.
And we're hearing stories already, in fact, of forward orders for discretionary goods starting to really slow down.
Yeah.
So, there's a bit of a lag effect here, isn't there? Which I guess goes back to the potential for a hard landing, simply because the Reserve Bank overshoots, pushes rates too high, and the data then comes through that actually says that inflation has actually dropped quite significantly. So it's, as you say, it's not an easy job for them to try and get right. The classic example, I think, is Paul Volcker, who was the head of the Federal Reserve in the US, which is the US's Reserve Bank, back in the 1980s, having to deal with significant inflation, and there was a massive recession there.
And as those of us who are old enough to remember that, there was a serious problem with inflation, not just there but globally, and he really took the job seriously of getting that down, and he did cause a recession, not just in the US but globally, but we have reaped the benefit of that action, and we've for the last 30, 35 years, we've had a period of low inflation, and that has been very, very positive for global growth and the global economy generally.
Well, I think prior to the introduction of the Reserve Bank Act, which said about the Reserve Bank being able to control inflation through interest rates, and the policy that they set around that, the target interest rates. Since then, inflation's averaged about 2.2%. Prior to that, it was about 12%. So if we've got inflation at the moment about 7%, I'm sure there's people, there's viewers who can remember that time when we had inflation rates of 12% and how destructive that was. So moving on then, in terms of looking at this from an investment perspective, what does this actually mean for investors? What does a recession mean? And should they stay invested where they are? Are things like assets like equities still a good class to invest in? Or if they've got some cash, should they still go ahead and get on with their investment plans?
Yeah, because we've been getting quite a few questions about, is it a good time? When do I invest in shares? Is it a good time to invest in shares? And so a recession is quite a scary period for people, because obviously the outlook is not as good, and in fact it can be quite dark, and so that introduces all sorts of uncertainty in people's minds, as you've just said. But what they've got to address is actually, where are they going longer term? What are they trying to achieve? So shares, for example, are a very good exposure to have when you're trying to deal with a real life challenge of inflation. Now, inflation is the hot topic at the moment, but when we're talking over 30, 40 years, it is the biggest challenge that investors will make, because even at quite moderate levels of inflation, they lose huge amounts of purchasing power. So that's a very big real life issue that equities or shareholdings or exposures, that helps enormously. But the problem is they're quite volatile, and so you've got to actually be invested, and not just now and not just trying to time it. You've actually got to be invested through various cycles. The problem that you have is that, like I say, our crystal balls at the cleaners, nobody knows what's going to happen. I mean, who knew that Putin was going to really knew? I mean, all the experts were saying he'd be crazy, but who knew that he was going to invade? Who knew about the pandemic? There's things that people think that they can forecast environments and so on. You can't. And so that's why you need actually a structured program where you are invested through various cycles. You don't try and time it, because what we do know as well is when shares or equity markets recover, if you're out of the market and you miss a few key days, you miss actually big chunks of that recovery. But nobody knows what those days are. So you've actually, that's where the advisors come into play as well, in terms of determining what people's objectives are longer term, and then looking at a properly structured program of investment. And then that's what Calibre Investment does, in terms of making sure that where people do have exposures, they are diversified enough, that enough research goes into understanding them. And also we have different types of exposures, like our multi-strategy funds and so on, that are very useful at times like these, but they help people enormously in terms of increasing the certainty around them achieving their objectives over their investment horizon. So that question of when's a good time to invest is really a bit of a moot question, actually, because if you've got life-saving serious money, you need to be invested. And that the other risk, which we spoke about I think last time, was that where people at times like this will then jump back into cash or term deposits, which is, it sounds crazy, is the most dangerous type of asset, or dangerous asset class over a long period of time, because of that horrible inflation thief, because term deposits and cash they get hit the hardest with inflation, and they are the least able to help people address inflation. So they need some of it in their portfolios. But unfortunately, we've seen a lot of behaviour recently where with the uncertainty has spooked people, where they've actually taken all of their portfolio and invested back into term deposits, which is not the strategy to have over when you have a longer investment horizon.
Mark, then just to round off the discussion, what is Calibre Investment actually doing in terms of the portfolios that it manages for clients in circumstances like this?
Yeah, well, as you know, we get a lot of questions. What are we doing specifically at the moment to do that? But of course, as we've said previously, we've done a huge amount of research and analysis and portfolio construction with the specific aim of actually building portfolios that travel through these periods in a way that helps our clients meet their objectives. And so for example, the multi-strategy funds at the moment are providing very good diversification in the portfolios and are actually having very good positive returns. And they're in the portfolio to be a non-correlated exposure with equities. Why do we want that? Well, we want to smooth out the bumps for clients, because clients have real life challenges. We just spoke about inflation with their purchasing power, but our clients have regular drawdowns just to fund their lifestyle. Well, they don't need the portfolio bouncing around all over the place.
Exactly.
And so we put a huge amount of effort into understanding what the risk exposures are. Even with the equity exposure, which can be more volatile, we work very hard to make sure that we have a well-diversified exposure and the exposures truly reflect what equities are supposed to be and do in the portfolio. And we're very pleased at the moment that the equity exposure is performing exactly as it's supposed to be, and so that nothing is sort of blown up or been problematic in there, and so it is performing very much in accordance with its design. The multi-strat funds, as I said, are helping in terms of being non-correlated and actually having positive returns. We have very deliberate currency exposures. They have helped very well, and some of our cash and fixed interest holdings are also performing. But those multi-strat funds, for example, multi-strategy funds, they are a result of our research over the last 15 years of working very hard to understand what they are, how they work, what sort of exposures they are, and what they contribute to a portfolio. So that's what's working for our clients right at the moment. And as you've heard from the advisors, we're getting quite good feedback from clients. They're pleasantly surprised how the portfolios are performing.
Absolutely. There's been this much more consistent performance. It's not as volatile as other portfolios that they may have heard about. They're not seeing significant drops, and that's one of the things that I think Calibre Investment is particularly good at. Is making sure that there is a long-term consistent approach to the way the portfolios are managed, because we know these things are going to happen. We know there will be recessions. We know that there'll be massive bull markets, there'll be bear markets. But it's all about having a consistent, disciplined, repeatable approach that provides the clients with the outcomes that they need to make sure that their objectives are successfully met over time.
Yeah, and that's critical to us. That's why we put the effort in, and we have the team and the research program and the monitoring program and so on. And so that's a really important focus for us. And so that's where we talk a lot about alignment. So that's where we are a bit different from other managers, because we actually work really hard on alignment with those real life challenges, rather than just say some obscure benchmark or indice that really doesn't have much to do with getting proper results for clients. So we work very hard at trying to make sure that the portfolios are aligned with those real life challenges. And so we're very happy with the way the portfolios are going at the moment. And the other thing is, because the portfolios do travel well through this period, it doesn't mean that they're laggards when the markets pick up. The portfolios perform well through that cycle as well. So it's not like you have to have this sort of over-engineered portfolio that doesn't perform on the upside. These portfolios perform well on the upside. But they are definitely delivering that more consistency that allows our clients to live proper, normal lives without having to look over their shoulder all the time and getting worried and concerned about why their portfolio is bouncing around all over the place.
Because they're busy enough.
Yeah.
I think focusing on things like what am I going to do if I have to suddenly sell the house and move into a retirement home? Or what if my other circumstances change, my social, or what happens if my health packs up on me? Rather than thinking my portfolio is massively underperforming, the Standard & Poor's 500 has fallen through the floor and my portfolio's gone with it. What am I going to do now?
And even the more mundane things of just spending time with their families, travelling, enjoying that stage of their lives and pursuing other interests as well. So so it enables them to lead their lives.
Thanks, Mark, and thanks for watching. We hope you found that interesting and informative. If you've got any questions, please feel free to talk to your advisor or get in touch with us via the website. There are other videos that you can watch about market and economic commentary, and we do those on a quarterly basis. Cheers.